The next step is being able to analyze a transaction. I have written the accounting equation on the board, and again, this is the one that I most often use. It's assets equals liabilities plus owner's equity plus revenues minus expenses. Now, when we look at a transaction, we're going to ask ourselves what accounts are affected, or what is affected up here. So for example, we might say, with assets, do we own something new, or did we give up something that we own and so we no longer own it? So that would be a change in our assets. Or we can ask ourselves, do we owe something new, or did we pay something off so we don't owe it anymore? Owner's equity, I have written the two relevant accounts here. So capital, again, is if an owner puts money into the business. I'm going to illustrate this. Here's the business. Here's the owner over here. Now, in accounting, this is called the economic entity assumption, is that the owner and the business are two different things. So we don't care what the owner does with their money. They could be buying groceries, buying a house, buying a car. We don't care. As the business, we don't know what the owner's doing. And the owner, the business is run separately from the owner's life. Let's put it that way. The owner's life and the business are two separate things. They're run separately. So, but there are transactions between the business and the owner. And so when the owner puts money into the business, that is what we call capital. When the owner takes money out of the business, that is drawings. Those are really the only two things that we care about with the owner. It's either capital or it's drawings. And if the transaction involves the owner, it's going to be one of these two things. So either are they putting money in the business or taking something out of the business. If it involves the owner, it's not going to be a revenue or an expense. And if it does not involve the owner, it's not going to be one of these two. So these two accounts have to involve the owner in some way, shape, or form. So just keep that in mind also when we're dealing with owner's equity, that if the transaction says it involves the owner, you have two choices. It's one of these two. So ask yourself that. Revenues, did we do some work? Did we earn some money? Whether or not we've been paid, we don't care. Or did we use up some more resources? Often that's cash, but did we use something up? And that would be an expense. So when we are looking at a transaction, and a transaction is simply something happened in the business. We'll go through several examples here of things happening in the business and see how that affects the accounting equation and where we put things. Now, what I'm going to do here is whenever we have a transaction, something happens in the business, we will say, all right, let's make an account to track that thing. We might have accounts already set up, and if it fits the account name that we have, we're like, all right, we'll use that one. If we don't have an account set up for it, we'll write it in. I've already written in the two owner's equity accounts, capital and drawings, but as we continue, we'll start making new accounts, put them underneath where they belong in the account types or the account categories. All right, so let's start our business. Often our homework problems start out with, the owner put $10,000 into the business. So let's start with that one. All right, so we are looking at this from the business's viewpoint, not the owner's viewpoint. So from the business's viewpoint, when the owner puts $10,000 into the business, what does the business have now? Well, the business has some cash. So that's our first account. We have cash. How much cash did we get? We got $10,000. Now, we're looking at the accounting equation. If we add $10,000 in assets, to get the equation to work, we either need to subtract some other asset or look at, did something happen over here? So let's go ahead and ask ourselves, do we owe anything now? No, we don't owe anything. We might ask, did we earn any money? And this is a common misconception with the owner. We didn't do any work. The owner just gave us the money. So it's not a revenue. Did we use anything up? No. So let's go back to these owner's equity ones. And we ask ourselves, did the owner put money into the business? The answer is yes. So now the owner has $10,000 in equity. If we run through the equation, what does the equation have now? We have $10,000 equals 0 plus 10,000 plus 0 minus 0. So the equation still works here. So 10,000 equals 10,000. All right, another thing that we might do is perhaps we purchase some supplies. So we have this $10,000. We're like, all right, we're ready to get started and rolling in this business. We need to go buy a few things. So let's go buy some supplies. This is not product or inventory. We just need some sticky notes, envelopes, and pens, and whatever else we need for the business. So we say, all right, we go out to the store and we buy $500 in supplies from Office Depot. All right, so there's two ways that you might be able to look at this. The more correct way is to say, all right, we now have a whole bunch of envelopes in our closet. We own those envelopes. Let's call that the supplies asset. So we're going to add a new account for supplies, and we're going to put it underneath the assets. We have $500 now in supplies. Now, we do need to find some other way to get this equation to work. So $500 in supplies. What else happened? Look through everything. Did we give something up to get those supplies? We certainly did. We gave up $500 in cash. So we also subtract 500 from our cash. So our assets overall did not change. We just shifted. Now we have less cash, but we have more supplies. So in the first one, we say, okay, well, if we add something to this side, we can add something to this side. Or we could also do it to the same side of the equation. For example, in this example, we added and subtracted an asset. We could do that over on this side too, which we'll see. All right. So another thing that we could do in our business is maybe we actually do some work, do the whatever our business is. Let's say we're doing some landscaping work, and we go mow someone's lawn, and we are going to charge them, let's say, $1,000 to mow their lawn. Let's say they don't pay us yet. So we have done the work, but they haven't paid us. They owe us money. This one is a little bit more difficult with the definition I've been using for assets. And so let's expand that definition before we look at this. Previously, we have said assets are things that we own. The more technical definition is things we own or we'll have future benefits. A future benefit of having someone owe us is we will get cash eventually. So that's a future benefit. So this is where we track what people owe us is in accounts receivable. So this is an asset. My board's a little tight here, but it's an asset, accounts receivable. So this person now owes us another $1,000. Now let's see what else happened in our equation, because we will always have at least two things happening in the transaction. You may have noticed that in the previous two transactions that we have to have at least two things happening or the equation doesn't work. So if someone owes us $1,000, we ask ourselves, well, why? Why do they owe us $1,000? And we look through everything, and what fits the situation, we might say, oh, revenues. We did some work. We earned some money. We did some work, and that's why they owe us. So we add $1,000 onto the revenue, into the revenues. Now, again, we might create an account, and we might say, call it mowing revenue or something like that. So we look under our revenues, like we don't have an account set up. Let's make one. Let's call it mowing revenue. So $1,000 there, $1,000 on our asset side. Let's say that person now pays us later. Now they no longer owe us. So they paid off the $1,000. Okay, they don't owe us anymore. But what did we get in return? What else happened? We got $1,000 in cash because, well, they paid us. So that happened. All right, another example is, what if we buy some advertising? And say, all right, let's go to the radio station. We're going to put an ad on the radio or some sort of streaming service online. Whatever it is, we are going to buy an ad. And so that is, and we're not going to pay it yet. They're going to air the ad. So they air the ad and we see it on TV or on the radio or online, wherever we decided to put this ad. We see it and like, oh, great, our ad is running. And now we owe money, right? Because we owe money because we haven't actually paid this. Let's say this cost us $750. This is a liability because now we owe money. We're going to call that accounts payable. So I'm trying to put my assets over here. Accounts payable is our kind of our general. This is where we put stuff. If we're owe suppliers or owe our advertisers, or this is just our general running of the business type of thing. Our everyday things that maybe bills. You can make it, of course, a lot more detailed. You could say this is our advertising payable. This is what we owe in advertising versus this is what we owe our suppliers. But you'll notice, especially as we go through the semester and do the homework, that most of the stuff ends up in accounts payable. We just kind of throw everything in there that we owe. At least the day-to-day operations of the business end up in accounts payable. So let's set up our accounts payable and say, all right, that's the name of our account, accounts payable. And we owe, what did we say, another $750. So our liabilities, or what we owe, went up $750. Now, where does this fit? Advertising. Well, the advertising is not something that we own anymore. It's gone and done. There's no asset there. We don't own anything new. The owner didn't put anything in or take anything out, so the capital and drawings accounts don't apply. We didn't earn anything. We used up a resource. We used up advertising time on the radio or on the TV, whatever it is. We used up some advertising time, and so it ends up as an expense. We don't have any accounts set up, and expenses, we generally track a lot of different things. So the current owner of this business probably wants to track advertising expense. So let's set up an account called advertising expense and put it underneath our expense category. So we have advertising expense. You'll notice up here that it's revenues minus expenses. So I'm going to put the minus 750 down here. Does our equation still work? It certainly does. All of this happened on this side of the equation, on the right side. We added 750 to our liabilities, and the expenses ended up subtracting 750 on that side as well. So our equation still works. So some things that you'll need to notice as you're working through homework problems, analyzing transactions, you always have at least 2 accounts affected, at least. Sometimes there's more. One that you'll often see at the beginning of a homework problem is the owner put in $10,000 in cash, $5,000 in supplies, and a $30,000 vehicle. Now that's all one transaction, but there's multiple things going on in the transaction. So you get cash, you get a truck, you get supplies, and you get capital. So there could be 4 different things happening. But it's at least 2. So at least 2, maybe more. The equation always has to work. So you'll notice that if I put something on in the assets, my assets go up, either another asset went down or something is happening on the other side. So we always have to get the equation to work. Another thing to point out is that, again, what is most important is not necessarily the name of the account, but where we put it in the equation. So what category do we put it under? And finally, this is difficult. It's sometimes, especially starting out in accounting and learning accounting, it's one of the most difficult things is learning how to do this and where things are categorized. And the best way to get through it is just practice. Just do lots and lots and lots of problems, and you will get better at it, I promise.